Thank you, Handy, and all the other organizers for the opportunity to present today. This is work that I've been doing with Professor Yves Mears and Gauthier Demar from Université Catholique de Louvain and ENGIE respectively. And the topic is, it's really a market design problem that we're investigating, but the interesting part of today's presentation, I think, is the modeling approach as well as the policy messages insofar as the Belgian real-time market is concerned. So I'm going to jump straight to the motivation. So we have in the Belgian market, as in numerous other I'm going to call it an energy-only market. So as in numerous other energy-only markets, we have this paradoxical effect of resources with high marginal costs, such as combined cycle gas turbines and oil units, that are particularly well suited for balancing the variability and the uncertainty of renewable resources. But the more renewables you put into the system, the more difficult you make the financial viability of such resources, because although they're quick to respond to variations, they also happen to be having a high marginal cost. So you see here the price duration curve of between January 2013 and September 2014 for Belgium. If you do a simple calculation, you find that these are the two most suitable resources for dealing with wind variability and uncertainty, and they are the two that are also in a dead end in terms of not recovering their fixed investment costs. And this reflects ultimately a difficulty with accurately valuing the services that these resources are offering to the system in terms of what I'm referring to as flexibility, but flexibility has many different meanings, so I want to be clear about what we mean by flexibility in the work that we are pursuing with Gauthier and Yves. So we are particularly interested in resources that can offer secondary and tertiary reserve, which is in US the analog of operating reserve in US operations. So definition of secondary and tertiary respectively are resources that can be providing full response within 7.5 and 15 minutes. So the mechanism I'm going to talk about today, which is referred to as scarcity pricing, or if you refer to Stephen Stoft's book, Operating Reserve Demand Curves, is aimed at correcting this paradox here by appropriately valuing this service here. So what this mechanism does is fairly simple. It's basically a price elastic demand function for real-time reserve capacity. That's what it really is. But in introducing that in the market design, what you create is a non-volatile price signal for real-time reserve capacity, which, because of no arbitrage conditions, takes with it along the way the energy price. So indirectly, by introducing elasticity in real-time reserve capacity, you're indirectly introducing elasticity in the demand for real-time energy. That's kind of the intuitive way that I reason about this mechanism, but I'll show some math to support it a bit later. So there's been a discussion in Belgium about the value that this design offers to combined cycle gas turbines. There have been concerns by industrial consumers that they are getting hit with an increase in energy prices, but one can argue that one of the best positioned resources to offer flexibility in the sense of secondary and tertiary reserve is demand response. So it should be possibly seen as a tool, not as an enemy for flexible consumers. A bit of the history of events that brought to today's talk. So our preoccupation with this topic commenced in 2015 when we went through a difficult winter in Belgium, where we ran very tight because we had unscheduled retirement of a big chunk of our nuclear capacity, which inspired the Belgian regulator to pose the question, are we providing sufficient incentives for investment in the Belgian market? And the specific question that was posed was, what would happen if we would introduce ORDC in the Belgian market? So we concluded a study back then which showed that the introduction of the mechanism can make a material difference for combined cycle gas turbines, in the sense that it could shift them from running at a loss, in the sense of not so they were making they were covering their short-term variable operating costs, but they were not covering their long-run investment costs. And once you introduced the mechanism, the situation changed, where they were breaking even, or even making a comfortable profit. So that caught the interest of the regulator. There was a follow-up inquiry about what happens if we tweak various parameters that affect the design of the mechanism. So the specific questions that were posed were, should we include strategic reserve in the calculation of available operating reserve capacity? I don't have time to, we can talk about this in the Q&A, but strategic reserve is something Central Western European specific, I think. Then there is, what happens if we change the value of lost load? What happens if the nuclear capacity that was out in 2015 would come back to service? What would happen if we were doing day ahead instead of month ahead clearing of reserve capacity? So there were these sensitivities to better understand the mechanism. And then finally, in 2017, the question was posed, can we just take this mechanism, which has been conceived for a US two-settlement system, and just plug this into the Belgian real-time energy price? There are substantial differences in market design. I'm going to talk about them in a minute. What can we expect in terms of implication of just putting this adder into the real-time energy price? And that's really what today's presentation is about. But two other interesting side activities that have taken place is that last year, these are indicators that the Belgian regulator is actually serious about implementing this. So last year, there was a request from the Belgian system operator to to conduct a parallel run of what the adder would have been in 2017, given the remaining available capacity in real time that was metered back in 2017. And the incentive for this year for the Belgian system operator is to actually be posting, as of October 2019, adders as they would have been faced if the mechanism were in place starting October 2019. So things are, there seems to be some momentum in this direction. So let me more specifically introduce what this design does. So as I mentioned earlier, you can think of it as basically a price, so this is quantity of reserve, and this is ultimately a valuation for reserve. That's just a price responsive demand function that you introduce in real time, and the formula that you use to calculate the height of these blocks is based on this expression over here. So it's VRLL minus the marginal cost of the marginal unit times the loss of load probability as a function of the reserve. So the more reserve that you do have available, the lower the valuation. And there's a formal reason of why you might want to use this expression here, which has been derived by Hogan in a 2013 paper, and it's based on this two-stage stochastic programming idealization. But ultimately, what this does for you is it looks very different from a very steep hard reserve requirement, because in a very steep hard reserve requirement, the moment you go below the requirement, you get a price spike, and therefore what you're seeing as an investor is an unpredictable pattern of very violent spikes, whereas here you see something more regular and less violent and more reliable in terms of betting on flexibility. So the sales pitches for scarcity pricing, as you might frequently encounter them, are what I just mentioned: more frequent and lower amplitude price jumps, which can occur even if you mitigate energy supply bids, and which can coexist with capacity market. And the rationale of the Belgian regulator is that This is a no-regret measure when we want to introduce corrections to the real-time market that does not preclude the existence of the capacity market. This is a slide of how things. This is actually implemented in Texas, among other system operators. I think MISO is also. I need to kind of go back to my notes, but I believe MISO is also implementing this now. But this is a couple of slides that we received from Texas back in the summer of 2015, where it was an unusually hot day. And here you see these adders, these expressions, as I computed them here, as they occurred for that day, as a function of how much excess reserve was available in SCED. So you see this scatter plot tracing the LOLP pattern. So this is really driven by this loss of load probability calculation. And what I think is interesting to note is what effect this has on the energy price. So here you see the energy price for the day. The red curve is the marginal cost of the marginal unit, which goes up to around $70 per megawatt hour. But when the system is running tight, you get these green jumps, which can go up to $430 per megawatt hour. And if you are a resource that can quickly regulate upward here, you are paid handsomely for offering that quick response in real time, and that creates a very strong business case for the resources that can do this, like combined cycle or demand response. So specifically, now that I've kind of introduced what the mechanism is, the questions that were posed to us by the Belgian regulator were the following, and inspired, oh boy, that's a compilation. So when should day-ahead reserve auctions, yeah. So that's a compilation error on my part, sorry. So inspired by the fact that the Belgian and the US designs are very different, the questions were the following three. Basically, should we have a real-time market for reserve capacity? Because we do not trade reserve capacity in real time in Belgium or in most Central Western European markets that I am aware of, at least. The second question, should we allow virtual trading or not? And the third question, does it matter if we simultaneously clear energy and reserves in the day ahead, or is it okay if we do it in sequence as we are doing it currently? What is the specific metric? The back-propagation of this price to day ahead market. So how do these designs influence the way in which the price moves from the real time, because this is a real-time demand function? How do these design choices affect how it moves to the day ahead? Those were the questions that were posed. So what we ended up doing, and this is a message for users or consumers of stochastic equilibrium models about the diversity of effects that you can capture, is that we developed a stochastic equilibrium formulation for a family of designs that could be considered, which are incremental steps from the current EU or Belgian design to the idealized two-settlement system. Every step of the way, we're trying to answer this question. If I make this new tweak to the design, what does that imply in terms of back-propagation of prices? So we start from our existing Belgian system, for which we don't really have a good equilibrium model. It's quite difficult to capture some of the things that we're doing with balancing. We suggest a uniformization of the balancing pricing, in the sense that balancing service providers should be paid the same as the entities causing the imbalances. And then that brings us to our starting point of a stochastic equilibrium model. And then we are investigating the impact of these changes one after the other on the back-propagation. So what happens if we introduce a real-time market for reserve capacity? This brings us to this model here. What happens if we remove penalties on imbalances when the system is very short or very long? This brings us to this model here. What happens then if we introduce virtual trading, which brings us to this model here? And then what happens if we introduce day-ahead co-optimization of energy and reserves, which brings us to the US two-settlement system? And what you will note is that every step of the way is a bit or a lot more disruptive than the one before. And our intention here is to check whether, by doing some of the less disruptive stuff, we can accumulate a lot of the benefits that we could hope for from scarcity pricing with the hope of actually seeing this through to implementation one day. So this is just a table that explains basically the nomenclature. It kind of explains the initials, but anyway, I'll be describing them in plain English later, so I'll just go straight to the model. So what I'm going to do here now is build up the model for the sake of introducing the notation, but also because I think that some of the things that I at least was taking for granted with very simple models of energy and reserve, maybe they deserve a bit more attention when you're doing the modeling. So I'm going to introduce the elements of the overall equilibrium model one by one. I start with a real-time energy market. So I have basically this product, which is traded between producers and consumers. So I have a set of producers, a set of consumers. Each of them is submitting price quantity pairs of either for demand or for supply. So the producers' quantities are P plus and their valuation, their marginal cost is CG. The consumers, their demand is D plus and their valuation is capital V. And the producers produce PRT, the consumers consume DRT. I can write this real-time equilibrium either in equilibrium form or directly as an optimization model in merit order dispatch form. So this is what it would look like in its optimization version. So that's our real-time energy market. So we're all set to get started with the model. And now I'm going to start plugging features in one by one. The next feature I'm going to plug in is virtual traders. Note that the virtual traders only take positions in the energy market. There is no virtual trading of reserve capacity, even in US markets where virtual trading is implemented, and there are strong arguments of why it should be put in place. You're not allowed to sell 1 megawatt of operating reserve if you don't actually own a generator. But you are allowed to sell 1 megawatt hour of energy in the day-ahead market. So now we have these virtual traders taking positions in this day-ahead market and then settling their position against real-time prices. So we have now a new market. So this is the new product. It's a day-ahead energy product. And these are the entities. There are now 3 entities participating here. So I have a virtual trader. I don't have this separately, explicitly as an agent in my model. I capture it by the fact that I allow generators to take positions in the day ahead that do not depend on their physical capacity. So if I want to sell more than my P max, I'm allowed to do so. That enables virtual trading. So the settlement goes that whatever I sell in the day ahead gets settled back, that quantity gets settled in a real-time price. And now I also need a day-ahead energy market equilibrium condition. Next element that we add is the real-time uncertainty. So we have either failures of components or forecast errors that are realized as a set of scenarios which I indicate by capital omega. And now things start getting interesting with the model. So this means that at real time I'm collecting a real-time profit which is random, and to capture risk aversion, we introduce a coherent risk measure which scores lotteries to risk payoffs. So I take a random collection of payoffs, and I assign it a score as seen from the day ahead, given my risk attitude. So
it's a utility function?
A coherent risk measure. So utility functions don't need to be coherent risk measures. So there's an axiomatic definition of these in the literature. So you can think of this as expectation or CVAR or a mix of CVAR and expectation. But there are other utility functions that don't need to obey this set of actions that define coherent risk measures. So this is now what the real-time payoff is looking like. I'm going to optimally dispatch in real time. I do have to settle my day-ahead position, and this whole thing is my random real-time payoff, which I'm going to score using this risk measure. And then basically this is almost the same thing as I showed you earlier, with the exception that the random real-time payoff is quantified by the risk measure, and that's how I've introduced the uncertainty in the model. Now, why are we doing all this? Let's not forget what the point was. We want to introduce scarcity pricing in real time. So it's kind of shocking to realize that this doesn't exist as a block in European real-time markets. And so that coming back to this comparison between US and European, but here is how you introduce it. You introduce a real-time reserve product. So you have a system operator who's procuring this using this demand function. So the set of segments that define the demand function is this RL, and the valuation of these blocks and their width is the VL and the DL respectively. And we also have for the entities that offer the reserve on the supply side, the ramp rate that limits how much of it they can make available. This is how much the suppliers of reserve are giving. They can be generators or loads. This is how much the system operator is buying, and this is a price for that product, for that service in real time. I could write it as an equilibrium. I'm back in the real time, so I don't have to worry about risk measures and all that. So I can write it as an equilibrium or as a co-optimization. Here I'm showing you the co-optimization version, but in the end of the day, this is the ORDC of Hogan and Stoft. It's a real-time demand function for reserve capacity. You have a market clearing condition for the reserve capacity. These are the suppliers of the reserve capacity and the consumer, which is the TSO buying it on behalf of everybody. And then how much of it I can offer is limited by my ramp rate as well as my P max. And this is what creates this link between energy prices and reserve prices that I'm going to come back to in a minute. So this is now how you add this element into the model. And if you look at the optimality conditions and you look at an interior point for a generator that is offering this reserve product but also offering energy in real time, no arbitrage means that that generator needs to be indifferent between his profit margin in the energy market and his profit margin in the reserve market. And that's where my intuition comes in for the mechanism. By having elasticity in the reserve demand, you create a more stable lambda RRT signal, but the energy signal is following in lockstep with the marginal cost of the marginal generator separating the two. So if you stabilize this, you are stabilizing this through no arbitrage, even if you don't have a elastic energy demand. So that's how I perceive the essence of scarcity pricing. And the last element for designing the two-settlement US system is introducing a day-ahead reserve capacity market. So it's the same principle as the day-ahead energy market. It's a financial market where we can sell reserve capacity in the day ahead, and then we settle our position for reserve capacity in real time. So this is how much we sell in the day ahead. And this is what a generator's problem looks like. He's now getting a payment in the day ahead, but then buying back his position at the real-time reserve capacity price. And you have an equilibrium condition for the day ahead reserve capacity. So this thing now that I've kind of set up here is the skeleton around which I will build up the European model to compare the two. But this is really the US two-settlement system as we perceive it in our work. So a very important feature of this model is that it explains how, by looking at the first order optimality conditions of the positions you can take in the day-ahead market in energy and reserve capacity, you can explain the back-propagation of the real-time prices, which are the ones that are affected by the scarcity pricing mechanism. But by looking at the fact that every entity is not supposed to be able to arbitrage between the day-ahead energy market and the day-ahead reserve market, you can explain how the day-ahead energy market should behave so that this arbitrage is not there. So that explains why the day-ahead energy price is the risk-adjusted average real-time price, and why the day-ahead reserve capacity price is the risk-adjusted real-time reserve capacity price. And once you start changing the design, you're basically messing around with this formula, which explains the changes in backpropagation that we are interested in. So this is overall what the US design looks like. So this part is simultaneous, and I want to talk to you about comparing this figure to how we conduct operations in Belgium, which means we do not have a real-time market for reserve capacity. We do not allow, at least explicitly, virtual trading of energy. What do I mean by explicitly? If you're a bank, you are not allowed to participate in the day-ahead energy market. On the other hand, if you have a portfolio of wind and consumers and thermal units, your forecast of renewables is really your private information, and the market, the regulator, or the system operator really can't check you on that. So you can, you can do stuff to introduce indirectly virtual trading, but it's not. It's a no-no. You cannot. You cannot do this explicitly. So we are assuming that you cannot do this at all, basically, in the model. So how do we model that? It's very simple. We just limit the day-ahead positions of the generator in energy and reserve capacity by the Pmax, and the reserve capacity by the ramp rate of the unit. How can we switch between having this or not in the model? Well, we just switch between the real-time clearing of energy only or energy and reserve. So those two features, virtual trading and presence or absence of a real-time reserve capacity market, are already easy to capture based on what I just showed you earlier. And the part that's quite tricky, and which was inspired by work done by Andy, is the sequential clearing. So I'm going to spend a few minutes explaining that part. So what is the idea here? The idea is to capture the qualitative difference between what we do currently in Belgium, which is we clear reserve capacity in week ahead for secondary and month ahead for tertiary, which means if I promise you 1 megawatt of tertiary, I'm kind of stuck with that promise for the whole month. There is a possibility to do bilateral trading afterwards, but let's assume this is our working hypothesis, that you're kind of stuck with that decision for a whole month. So what does that mean? That means you can't really adjust your decision to the specific conditions of a given day. And Belgium is like that now, but there's a strong push by the system operator to do day-ahead clearing of reserve capacity, because they recognize that you can get more value out of your capacity by adjusting your reserve requirements to the specific day. In particular, the following day might be a very difficult day, in which case you might have a very wide spread of renewable supply in real time, or it might be a moderate day, in which case you have a moderate spread of renewable supply in real time, or it might be a very easy day, in which case the spread is very minimal. And the question is whether you get to learn that when before or after you've decided to trade the reserve in the day ahead. So the sequential clearing says you get to first commit to the reserve capacity without knowing which of the three types of day it will be, and then you enter the energy market. Whereas sequential, simultaneous means that the two are decided at the same time and contingent on what type of day it will be. That's how we're modeling this sequential versus simultaneous clearing. So this is an example of how you could populate that tree depending on what type of day it is. You don't see any parameter here, you just see information that tells you what the parameter values will be here. And that's that. And then there's these really kind of the quarter past. Okay, so I have a few more minutes before I show you the 15 minutes, right?
No, 5 minutes then.
I thought it's 40, so 15 including Q&A, right?
Yeah.
Yeah,
so
cool.
You have 5 minutes.
Got it. All right, so there's these additional features that are really important, and they're really, in the end of the day, the heart of our recommendation to the regulator. One is, capturing the fact that secondary and tertiary are substitutable. This one is extremely important. Inelastic requirements for reserve capacity. I'm going to comment on that in a minute. And there's the penalties on deviations between day ahead and real time. So I showed you the basic Belgian model, but now I want to talk a bit about these specific aspects. And actually, I want you to look at the generator problem. I know it's horrible, but just bear with me for a minute. This is the real-time problem of a generator. In Belgium, we tend to penalize if you deviate between your day ahead and your real time. I captured that with these slack variables that I defined here. Not so too important. I want you to emphasize on this constraint over here. This constraint is saying you should carry reserve in real time, which is at least as much as what you promised in the day ahead. You can argue both ways on this. You can argue that this constraint should be dropped because once this is reserve capacity after you've balanced. Yeah. Why protect even more? So that's the argument for dropping it. But then the new imbalance interval is coming, so you'd better be ready. So that's a constraint to include it. The bottom line of the reality of the thing is that so generators in Belgium know what to do, what they are supposed to be able to do before the balancing is initiated. But it's unclear what they're supposed to be doing after the imbalance has been cleared. And that's when the scarcity is measured in the system. So what we're saying in this work is you really need to be measuring the remaining capacity after the imbalance has been cleared and sending price signals for real-time reserve capacity on the basis of that measure. So that's really what the case study highlights, and that's our basic recommendation to the regulator. Now, before I show you the numbers that support that, this is just the, if you were interested in understanding how this model works exactly, this is the real-time profit maximization of a generator, this is the day-ahead profit maximization of a generator for energy, and this is the day-ahead profit maximization of the generator for reserve capacity, but I don't have time to cover those in detail now, and I will just show you the numbers that we got for using this model, but for the realistic numerical study, we needed to assume risk neutrality to be able to solve it as a stochastic program. We have toy examples which show the workings of this equilibrium problem, and they're very interesting effects, but numerically it's too difficult to deal with, so I'm not going to spend any time on that now. I want to give you the policy message. So this is what energy prices look like. This is what they look like historically for these 9 months that we simulated the Belgian market. This is what happens if you are carrying these red constraints here. So you have very strong scarcity, which is kind of expected because you're carrying reserve even after you've activated. But if you drop them, the energy prices collapse. So there has to be a middle ground. Now, between these two extremes, we are enveloping the historically observed values. So these are envelopes of the historically observed values. So that's kind of a reasonable validation. But none of these is helping with scarcity pricing. So the key element that needs to be added to the design, which brings prices to a reasonable value, and I will argue in a minute why that's reasonable, is introducing a real-time reserve capacity market. Then what we find for the risk-neutral model is that penalties on imbalances, virtual trading, and simultaneous clearing are of secondary importance. So let me quickly argue why this is a reasonable value, and I will wrap it up. So this is, the reserve prices, which we show we can get as a side product of the model, and they explain the energy prices, but this is a slide that argues why the prices are reasonable once you introduce a market for real-time reserve capacity. So if you have these red constraints, so what I'm reporting here is annualized cost of capital which depends on how much you assume an investment will be around for, and depending on different rates of return. So we're saying that anything that's making below 6.03 euro per megawatt hour in profit is in trouble. Anything that's making between these two values is breaking even. Anything that's making above 866 is quite a bit, maybe too comfortable. What you see is that if you drop the constraint I talked about earlier, there are 4 out of the 8 combined cycle gas turbines in the Belgian market that are not making back their cost of capital. If you introduce that constraint, they're too comfortable. No one here is is breaking even. If you introduce scarcity pricing in the sense of a real-time market for reserve capacity, you have 4 out of the ones that are in bold moving to breaking even, so italic funds, and one of them is making comfortable profits. So it's kind of achieving what you want in the first place of taking units that we know from practical experience need to be able to stick around, and creating a signal that's just breaking them even without creating excess profits. And that's really our message to the Belgian regulator, subject to the limitation that this is a risk-neutral model based on a stochastic programming solution. There's some examples that we can create which show the richness of the stochastic equilibrium, but no time to talk about that here today. You can explain this with the back-propagation formulas, but I don't have time to do that now. I prefer to leave some time for Q&A, and that's really the message of the analysis. So I'll be happy to take some questions.
Okay, thank you, Nancy, for a very detailed talk. I think you know someone who says about electricity markets and the devil's in the details, and you certainly went into a lot of detail there with a very comprehensive model. I only had one question, I'm only allowed one question, and it kind of relates to risk aversion, which I think is a feature of your model with this risk measure. And you showed in your last slides that really risk neutral evaluation gave you cost recovery for the agent. So why would you bring a risk measure into this model?
We want to be able to clarify whether our conclusions about the importance of virtual trading and the simultaneous clearing of energy and reserve capacity are relying heavily on the assumption of risk neutrality. What we are really curious to find out is whether by introducing risk aversion, we have very different back-propagation patterns, and as Gautier has very correctly pointed out, it's not even necessarily about back-propagation. What really matters is welfare and its allocation to different market participants. So what we would like to understand is whether this conclusion of virtual trading and simultaneous clearing are less crucial, is robust to the assumption of risk aversion.
So you're going to have to solve that risk-averse equilibrium problem.
Correct, and the best we can do now is solve very small examples. I think that being able to solve this extensive numerical study is a bit too ambitious at this stage.
Do you know if the stochastic equilibrium problem has solutions? Is it an equilibrium?
Yes.
You will not find it.
And you can add about uniqueness, etc. That's that's the yeah.
That's exactly my question. Also, with the red constraints, the problem becomes generalized mesh, right? Or I'm wrong?
No. These are your own decisions. It's a question of but
one comes from the data, right?
But it's your own private.
Yeah, but it's two different optimizations, and it's generalized mesh. Or maybe I'm wrong.
The way the way I understand generalized Nash is that my strategy space depends on somebody else's decisions, whereas here it's really
your decision, but coming from different optimization problems.
Right.
I'm not sure. Maybe Jiangxi can say, or you can say it's generalized.
It looks that way.
Pardon me?
It looks generalized.
Yeah.
But they're not developing existing theory or things like that. So it looks like it.
But you're running open loop. You're solving simultaneous. You're optimizing day ahead in real time all at the same time, right?
Okay. So
yes.
So it's one optimization problem.
Yes.
The day ahead, seen from the day ahead, no, you cannot cast. So seen from the day ahead for a single agent it is one optimization.
Which is what that is. Okay.
David has a question?
Well, comment. This is exactly the same as the capacity payment in the old electricity pool in Britain in 1990, and it was done day ahead. But everybody, because it was centrally dispatched, all of the data on the basis of which you could dispatch demand was known.
Yeah.
But the important thing is, it's exponential essentially in the scarcity. So in practice, you get a small number of hours a year of really high prices. So the idea that this eliminates the peakiness of prices, I think, is a bit doubtful.
For day ahead, so I believe in fact that even in the current UK design, there is a notion of
It's a different mechanism. The Irish, the single electricity market has an adder that the system operator will impose like this, but
yes,
scaled down.
but
so
is
that
it based on real-time measurements or?
Yeah, it's in the balancing
Yeah.
market.
So you're doubting that the so one thing that I should note is that the numbers you're seeing here are averaged over a variety of system conditions. So for any given limited sample size, you might be observing peaky behavior, but when you're averaging over
Then the question comes down to, and Richard will remember because I think he had to deal with the complaints, had you hedged ahead, in which case that short-run, very high price wasn't a problem, and if you haven't, and you suddenly woke up and in time, instead of it being £20, it was £1,000, then you get very upset. Indeed.
Doesn't the reserve make the price go slowly up, more slowly up than it would without the
No,
reserve?
the typical thing is that, and the worst case was some French nuclear power stations fell over. So all of a sudden there was a big shortage in the market, and therefore the reserve margin fell to the point at which the value of lost load was appreciable. And with a reasonable value of lost load, the price spiked in those small number of half hours.
these failures lasted for an extended amount of time.
Well, the demand then changed.
So this is a type of measure that can't really protect you from systematic. I mean, you know, this design will do what an energy-only design would have done in the first place for a systematic extended shortage. But for short-lived contingencies or
By
significant.
definition, the peak doesn't happen very often. And this is dealing with the scarcity, and that's going to be a few hours a year.
It's more than that because you can get rewarded consistently for being fast.
Okay, you're doing it in a 5-minute market.
Yeah.
Yes, whereas the pool was a half-hour market.
And also based on day-ahead forecast, based on what you're telling me.
Yeah.
Whereas here, it's the real time that drives the price signal, and the entities that can, in real time, deliver the promised reserve capacity will be paid for it.
Okay, so it is.
I have another question about the reserve. The reserve effectively is constrained by the headroom in the generator.
Yes.
Is that? I mean, if you went to a more detailed model, there would be other constraints on it, right? Which would be
Which is still the case in what I want to say.
you've got generation plus reserve.
This is the Belgian model, so we don't. Yeah, here. So if you look at the U.S. standard two-settlement system, that's how it is actually set up. Where do I wanna go?
Yeah, that one there. Yeah.
Yeah.
Improved value.
In the European markets, that's what I'm saying. It's unclear what, you know, we know what R should be before activation. We don't know what it should be after activation. So as far as guidelines go, as long as you're not exceeding the actual physical production after activation, you're fine. You're within your feasible region. So then the question becomes: do you still, do you still want to be carrying? I lost it again. Sorry. I'm sorry for this. I'm even getting dizzy. The question is: do you still want to be carrying that even after you've activated or not? And that's ambiguous. That we're saying it shouldn't be ambiguous because it makes a tremendous difference in terms of payment of flexibility.
Even before you're activated.
We don't have a before activation variable. Effectively, is what I'm saying.
Thanks a lot, Tony. That's great. So with implicit virtual bidding within the generators,
Yeah.
I guess just they are simply doing some scheduling, right? And in Europe, I think it's okay having some scheduling. Maybe it's okay to justify it this way.
Implicit virtual bidding is self-scheduling.
Generators can find their position.
So I'm not feeling comfortable to tell you a definitive yes or no. The thing that really, it's kind of difficult to describe, but if you tell the TSO that I'm nominating 100 megawatts for tomorrow because my forecast of net demand is 100 megawatts for tomorrow, they're going to be fine with that. But if you tell them, I'm nominating 100 megawatts, but I really know that my net demand is 90 and I'm indirectly shorting 10, they don't like that practice. So in both cases, in a sense, there's this notion of, it's hard for me to talk about self-scheduling in a European design given this nomination setup, but that's all I can tell you, is based on discussions we've had with the TSO, saying that I'm nominating 100, but in reality, and this is unverifiable information, I know that I have a net demand forecast of 90, but I'm telling you that my net demand forecast is 100, they really don't like that. That's all I can tell you.
Do they really detect it and bang on anybody? I mean, in California, we couldn't do anything about it in 2000. In fact, that was the law of the market design.
But what is shocking is the discussion and how strong the reaction is. But no, the answer to your question is no. But just
this is what happens when you get engineers designing markets.
Just bringing up the observation can create very interesting conversations.
Yeah.
Thank you so much. Maybe we should stop here, please. See you in half an hour.
Okay.